Joining me right now is Andersen Capital Management Chief Investment Officer, Peter Andersen. And Peter, it's good to see you this morning. Thanks very much for being here. What's the impact of 4% 10-year, in your view?
Boy, Maria, in my career, I've never seen such rapidity in terms of raising rates. We had the Fed, it seems ages ago, but only recently the Fed was saying transitory, transitory, transitory. Now they have totally pivoted into a very, very aggressive rate hiking regime. And I am very worried that they've got a blindfold on and they're not actually looking at any of the data in real time, even though they have always been bragging that they're data dependent. So this could really end up even crushing the market even more. And right now, there's really no place to hide in equities or even in fixed income. So it really does concern me that they're not looking daily at the data and anticipating the rate hikes that they've already made and the impact it's going to have on the economy and the markets in general.
Yeah, and we keep hearing central bank officials pushing the same thing we heard at Jackson Hole, more rate hikes to combat inflation. Minneapolis Federal Reserve President Neil Kashkari spoke with the Wall Street Journal about this yesterday. Here's what he told the Journal.
The economy is sending us a lot of mixed signals right now. We need to keep tightening policy until we see some compelling evidence that underlying core inflation is actually having peaked and heading on its way down. And then I think we need to sit there and we need to pause and wait and let the tightening work its way through the economy to see at that point, have we done enough?
So, Peter, this is in step with what we've been hearing from the Fed and certainly the dire predictions from so many people about the economy in 2023 continue. Here we are at the end of the third quarter. Fourth quarter begins next week. Are we going to start seeing this in real time, what you're talking about, an economy that deteriorates as rates move higher in a fast way?
Well, it almost seems like the Fed is burning down the village to save it. I mean, some of the things in that quote we just heard, I agree with, but it's a very mixed message, and I wouldn't even call it balanced. I mean, it's one thing if they're going to talk in a balanced way, but the fact that they're saying, let's wait and see if our actions play out. I totally agree with that, but they're not acting. The best way to interpret what their real intentions are is to watch what they do, not what they say. Yeah. And so far, they're sending a very confusing message. And also, Maria, whenever you talk to a Fed official across the country, there are many of them, they're not singing from the same hymnal, are they? I mean, they have their own independent opinions, which actually compounds the confusion. So, there's not much of a thesis for holding or even buying stocks at this point. I would say the only thesis that I have right now is the idea and the anticipation that the Fed will get sober and look at some of the impacts already that we're seeing from the rate hikes months ago. Yeah. And they will make a more formal, unified announcement that does say, hey, everybody, now we are starting to see the impact of our decisions, and we are prepared to slow down this regime and see how it plays out.
Dagan.
But, Peter, that's the hope and the fantasy and the dream that speculators and gamblers and stock investors, Bitcoin, crypto investors have been hoping all summer. And it's not, the Fed has, there's only one voice that matters, and it's Jay Powell. And he's made it clear the Fed is not only trying to fight inflation, but they're fighting against what the Biden administration continues to do, and that's foment inflation. And he said, we will tolerate a recession in order to fight inflation. And that's the end of it. And investors seem to be waking up to the fact that dip buying isn't working right now, and it's shaking their psyches. And when you can get 4% in a short-term treasury, why put your money at risk when, again, the big thing, like Apple's ditching iPhone production increase because demand is faltering? Yeah. Tighter monetary policy and a weaker economy has consequences. And this is going to play out not for a few months, but a year and a half from now.
Well, we're not certain how long it's going to take to play out. I do agree with a lot of what you said. However, there is always the possibility, and I've seen this before, when we have maybe one more earnings quarter and the Fed does start to say in a more balanced way that we have been acting too aggressively, even in spite, in the face of all those issues that you mentioned, Dagan. There does have to be, it's just too rapid, the changes that they're making. And history will show that there are unintended consequences. The Fed has a tradition of moving more slowly, more measured. And when they accelerate like this, I think it has everybody worried because they don't have any more data than we do. And I think it's dangerous to pivot so quickly and to keep raising rates the way they have been.
Can I add one thing real quick, Maria? If you're watching the 10-year right now, the yield is plummeting. It's down below 3.9%. So maybe that 4% attracted some interest from investors. And that's why you're seeing money flowing into it, other than what's happening overseas, too, with Britain.
Yeah. Peter, good to see you. Thanks so much.